Feldstein, and thank you for joining us on the Ask Andrew show this week, Canada's first Facebook live streaming family law question and answer show. I'm the principal of the Greater Toronto Area family law firm, Feldstein Family Law Group, and we have offices in Markham, Vaughan, Oakville, and Mississauga. Today, we're joined by a very special guest, Mr. John Fisher. He's here to discuss how individuals who are dealing with or have gone through a separation can learn how to properly manage their assets in their post-separation life. John is the founder, president, and chief investment officer of Bridgeport Asset Management, with decades of investment wealth management experience and numerous financial accreditations. John assumes ultimate responsibility over his firm's investment strategy and management of client relationships. And I should also note, I've been a client of John's for many years, and I think he's very knowledgeable and well-versed in this area. Without further ado, John, welcome to the show.
Thanks very much, Andrew. Thanks very much, Andrew. Really appreciate it.
Okay, so I want to discuss something that happens is we have clients, they go through the divorce, they're working through the settlement, and then they get their settlement and they have to figure out what to do with their money. And that's where somebody like you comes in. I always remember one time I had a client who was very anxious about leaving her home. And we got her a settlement, may have been $5 or $6 million. And this was a lady who was living in a small condo, had been separated for 10 years and didn't do anything with the separation for years, and it languished. And now here we were, she made us deliver the check to her home, and she's getting one check for $6 million. What do you do for somebody who all of a sudden has money, they're coming into it, and they need advice?
Excellent question, Andrew. I mean, it's a huge issue for some people that we've dealt with in the past, because often they've never had access to that kind of money all at once sitting in their bank account. Often we'll deal with a spouse after a separation where it's possible they've never really dealt with any, of the money during the years that they were actually married, and then all of a sudden they've got all this money and they've never really managed the finances. We often find when we have couples like this too that one half of like the couple will be the one that's handling finances. So it can be very overwhelming for a spouse to all of a sudden have access to the money and not really know a lot about what to do with it and how much money they should be spending or else not spending. So I'd say, from a very general perspective, it's a lot about education and sitting down with a client and educating them on the various options they have. It's a lot about reassuring them and giving them kind of reassurance that everything will be okay, because often there's a lot of anxiety that's associated with the situation. They've, after all, just come out of like a divorce. So there's been, I'm sure, lots of emotion, lots of tension. As a baseline, a really good place to start with a client is to come up with a financial plan, which one element would be to sort of work through a budget for them, and that often gives them a lot of confidence. So it gives them a sense of sort of how much money they've been spending in the past and how much money they can spend going forward. So that's a great place to start, and from there we'll work on the investment plan.
Well, it's interesting when you talk about the budget, because I find, at least in family law, when we have our clients do their budgets, and by the time they're coming to you, they should have done their budget, they find out that their budget usually far exceeds what they believe they were spending, especially when they're the spouse who wasn't paying the bills. And it creates some challenges of knowing what really is the target, what really is the number. And the other thing, and I don't know if you have this experience with the clients, I go and I get clients, say if I'm acting for the woman, the one who didn't have the investment experience, I'm being stereotypical, sometimes it's the man, but they're in a situation after a long-term traditional marriage where now they have this, what's going to be a stock portfolio and spouse support coming in every month. And I warn them, if the payor is 62 or 63 years old, you can't necessarily count on that spousal support lasting that much longer. And I try to tell them, and I'm not present when they meet with you or somebody like you,
Yeah.
but I try to tell them, you got to tell your advisor the spousal support may run out, and you got to plan as if it may very well run out. Do you deal with that? How do you deal with that?
Yeah, I mean, it's a very common issue, and you know what? It's not necessarily, in some respects, an issue that's specific to someone that's just gone through a separation or a divorce. I mean, almost everyone that we deal with at some point, unless they've got a sort of pension from their work, gets to a point in their life where they kind of retire and their main or only source of income that they have to live off of is in fact their like portfolio that's being managed by us. So it can be kind of a scary thing for even people that aren't going through a separation where all of a sudden there isn't any money coming in from the job they've had the last 40 years, or say from the business that they've owned for the last 40 years that they've now sold. So it's a fairly similar kind of situation where there's a lot of fear involved with that they're really just living off of the investment income from a portfolio. And so it does require more careful planning, both on the sort of cost of living side of things, as well as taking a really hard look at how they're going to invest their assets going forward so that they can generate the level of income that they feel they'll need to support their lifestyle going forward. You know, it's to some extent, it can be a little bit of a trial and error type of situation as well, where on the cost side, as you alluded to earlier, sometimes they're not really sure what the costs are. So we'll sit down with the client and say, well, let's measure it for the first 3, 4, 5, 6 months, and then we can get a real accurate read.
Okay, well, and has the pandemic changed anything in terms of how you're advising clients in that situation?
One thing that we've seen, and I'm sure all of us have sort of read about in the press, is that generally speaking, through the pandemic, people are spending a lot less money. There's been less to do, so often their expense budget has really come down significantly. Some of those expenses are probably kind of deferred into the future, things like holidays, vacations. I think we all know that's going to explode once things are completely open. So, generally speaking, we've seen people saving a lot more money, you know, since the pandemic started. I mean, that's probably the biggest thing. The second thing we've seen is obviously people, you know, came out of the first quarter of 2020, which was a pretty scary time in financial markets. Obviously, it was the onset of the pandemic in sort of March 2020, and the stock market took a very significant dip. Of course, it's bounced back, you know, very nicely since then, but people have, you know, pretty good memories. And so they're worried about their portfolios from the perspective of managing volatility and managing risks, because as we said earlier, they are living off of their portfolios in like many cases. And so they're concerned about losing principal.
So that actually leads quite nicely into my next question. How do you manage the expectations? Because I've always thought when you have an income stream coming in and you feel good about your income stream, there's a greater amount of comfort to survive those swings that can take place in the market. And the younger you are, theoretically, it's easier to tolerate it because you have lots of time. But the client who's coming to you in their 60s with, I think, a limited amount of spousal support in terms of years coming, or sold their business, how do you manage those expectations? Because I think that's a far more scary situation when you see a significant correction.
Sure. I mean, obviously, it's all about managing risk and reward. They do go hand in hand to some extent. The two free lunches that you get in terms of investing, I would say, are two kind of rules of thumb. I mean, always invest in kind of quality assets. Quality assets over the long term will always do well. And we could talk a little bit more about what I mean by that, but just by way of example, you know, higher quality stocks will always come back over time versus lower quality stocks. And the second free lunch that you get in terms of managing, you know, like your investments is having proper diversification I would specifically say that means having a good level of like diversification in terms of asset mix. So having the right mix of stocks, bonds, and other types of alternative assets that may not necessarily be tied or correlated to the stock market. And why that's important is because one segment of your portfolio might do well one year and it'll offset, say, one of those other segments that isn't doing as well. And overall, it balances things out nicely and will give you a smoother, rate of return month over month, quarter over quarter, year over year. So it's really important to have the right mix of assets and the right sort of asset segments, whether that's fixed income, publicly traded stocks, or all sorts of different alternative assets, and also private assets that will help you generate income.
Okay, now, in the situation that you've assumed the financial management role for, say, when the parties are married and now they separate, do you see sometimes both spouses continue to use your services?
Excellent question. That happens fairly frequently. We think it's if it does happen, it's a testament to our relationship with the with both kind of spouses in the relationship. In that they feel that they can trust us going forward to handle their assets separately, and they're completely separated and everything is completely confidential. So we obviously like to see that happen. That's our preferred outcome, but it doesn't always happen, obviously. Sometimes we could have a better relationship, say, with the wife, and the husband just feels like for some reason there's a perception that we were closer to his wife, and they separate, and he just decides to sort of move his assets elsewhere.
Well, I guess I'm confused because I look at it and I say, I'm not sure what role you could do to give an advantage to one spouse over the other when your obligation is really to maximize wealth for both of them and the same interest applies. Am I missing something?
No, and in fact, as you're sort of alluding to, as a independent portfolio manager and investment counseling firm, we have a fiduciary standard to act in the best interests of all of our clients. It's a legal standard, at sort of common law and as well as under securities regulation. We need to act in the best interests of our clients, irrespective of the situation or any other kind of relationship. If we ever felt where there for some reason was a conflict of interest where we couldn't manage assets for any sort of two of our clients, then we would obviously tell them that they should find some other manager. But it's never really come up, and sometimes we'll even if through the kind of process we've seen sometimes a former husband and wife will actually maintain a joint account with us. Often it could be an RESP, and we'll have to work, as it relates to that one specific account that they've kept in their joint names. We will work with them on a joint basis for that account, and in that case, obviously for the long-term sort of benefit of their children.
It's interesting you say that. It's not for you to say, but it's fine for me to say that I am a customer of yours. And I know after I separated from my ex, she told me that she was continuing as a customer. I have no idea whether she still is or is not a customer of yours. But I do know when you give the example of a joint RESP that we do have one through you and that you work with both of us that way. So I'd like to think we're easy to deal with. I don't know whether we are or we aren't. You're obviously not going to answer that question right now because you may say we're not. And you don't want to upset somebody. But the point is,
Andrew, you are always easy to work with. Yeah.
I'm sure every lawyer in the family law bar in Ontario would agree with that statement. Yeah. But at the end of the day, it's about you maximizing wealth for your clients. And some people, obviously, I see it in my business, they need more help, they need more hand-holding than other clients. And there's nothing wrong with that. It's a question of it's an anxiety issue when you see, I think back, today's Wednesday. The last 2 days of the market has been good, and Monday was a disaster. If you're that client, and this is where I'm really going with the question, I picture that client who does not have investment experience, who now just got their settlement, and I picture them giving you the check on Friday, or let's not say Friday last week, Wednesday or Thursday last week. You put it in the market, and then their first day they're down 2.5%, 3%, and that can happen.
Yeah, yeah.
How do you deal with that?
Well, first of all, I'd say we generally, if we were, someone was giving us, say, a $6 million check, for example, we wouldn't invest it all at once. We would do it over a period of time to try to average into the various asset categories. But it's a lot about education, and sometimes we have clients at both ends of the spectrum in terms of investment sophistication, where we have very sophisticated people that work in the investment industry themselves that don't need a whole lot of education from us. And then we have people that come to us that may have a lot of money, but because of circumstance, they really don't have any investment knowledge at all. And in that case, we spend a lot of time trying to educate them. It's really the key word about how stock markets work and what they should expect going forward, and what's a reasonable expectation going forward, and what isn't. And through that process also, it really helps us figure out what type of portfolio we should construct for the client. For example, if we get a client on board who we can tell is very anxious, very nervous, and we run through scenarios with them about, well, how would you feel if the portfolio behaved in this way? And they said, well, I'd be really upset in the short term. And then we said, well, we need to build a more conservative portfolio for that client. Whereas, if we test it out and clients understand that it's over the long term, there's a certain level of investment performance they can expect, but in the short term, there are things that can come up. There may be more volatility, then we'll build a different type of portfolio. And it really flows from the investment personality of the client. It's not that much to do with the dollars and cents. It has more to do with the psychology of the person and their kind of makeup. And sometimes that changes over time with education, confidence, and time. They may start out one way, and over time will shift their portfolio into a slightly different asset mix because just through education and things of that nature.
So one of the things that we have happen in our business is, we as lawyers, we do the agreements, and then you as a financial advisor, you have to deal with the mechanics of the agreement. And one of the fears we have is that when we paper the agreement, we haven't done it right for you in terms of you doing the mechanics. Now, what I mean by that is, I'll take an example. When somebody has an RSP, let's say husband has $1 million in an RSP and the wife has 100,000 in the RSP. They have a choice they can make. They can include it on each of their own side of the ledger for equalization of net family property. And then we fight about what the notional disposition cost should be for taxes. And sometimes that could be a real fight.
Right.
And sometimes people say, well, I want more cash today and I want less RSP. So one option people have, and they may not realize it, is they can actually roll over RSP money from one spouse to the other on a tax-free basis. When you do that, it frees up the notional disposition cost that we get into an argument about, which is a nice way, reducing arguments, reduce legal fees. But then the problem is when we roll it over, how do you deal with that rollover? Because if you have a joint account holder with you, well, an RSPs wouldn't be a joint account holder, but one of them has RSPs. Are you rolling it in kind at that time based on a stock portfolio? You're rolling it on a dollar value? Because you don't realize it until something happens, that if we send you something and the parties think, okay, I had 1,000 shares in Apple, I'm going to give you 500 shares, but our agreement says we're going to give $500 times the value of the Apple shares. Well, what's getting rolled? The timing can happen that can affect it. You ever had those kind of problems?
Yeah, I mean, usually we'll talk with the lawyers if it's unclear, or get a pretty clear instruction from, both both ends of the couple, like the husband and wife. From a tax perspective, whether we roll something in kind or in cash, is thinking it through. If it's in an RSP, it's sort of less of an issue, unless the client has a view like, I want to make sure I stay in Apple stock because I think it's going up tomorrow, and I don't want a 2 or 3 week period where I'm in cash versus Apple stock. But often things come over in cash because the client we're working with is probably looking for a fresh start. And if it's a registered account, I guess there's no real impact from the spouse that's transferring the assets. If they sell them before, there won't be any tax, and we can get started on a new plan once we receive the cash. But it really could be either one. I mean, we see both situations.
Well, and one of the problems you get into is, I say to somebody, if you're agreeing you're going to roll over, say, 300,000 in RSPs, and it's in your separation agreement that you're rolling over 300,000, I usually will tell them you should sell that $300,000 and put it into cash in the RSP right away if you're supposed to roll cash. Because if you wait 2-3 weeks and you get the timing wrong, you're playing with somebody else's money and you're going to have to make up that shortfall.
Exactly right. Exactly right. And so we often, what we'll see is, we could get a call from a husband or a wife on a Monday morning, and it looks like the marriage is broken down, and perhaps they just recently established a separation date. And often they'll want to go to cash in all their investments sometimes, just to sort of crystallize everything in terms of value. Which I'm sure is an issue that you see a lot in all sorts of scenarios, whether it's private company shares, publicly traded assets. You're crystallizing the value on that date of separation, and we often see kind of couples calling us up and saying, it looks like we're headed for a divorce, we've separated, let's just sort of go to cash or sort of partial cash.
Well, there's actually good reason to do that. The first reason, it gets to the concept of I'm playing with somebody else's money. If I'm joint owners, let's just say, for example, I'm a T4 employee, I don't own a business, and I don't have a pension. And I own the house jointly with my spouse, but I have a $2 million stock portfolio. It doesn't take rocket science to know my equalization payment without any tax consequences is $1 million. Then it means I'm playing again with somebody else's money. If it goes up, I win. But if it goes down, I lose. At the very least, I may want to cash in enough to cover my payment that I know I'm going to owe my ex and just put it into a GIC while I'm waiting to pay, because that covers me in case I have poor timing and it goes down. The other reason is a common one too, and this happened in my circumstance, as you may recall. When I told you that I was separating from my ex, I told you to sell all of my non-registered assets because I needed money to buy a house. And once you make that decision that you need money to buy a house, again, I think you would agree with me, if your horizon is a few months in the stock market, you really don't have any business being in the stock market.
Yeah, exactly. No, that's exactly right. I mean, and sometimes during periods of very unusual activity in the stock market, usually a major decline, you see some very interesting activity around that. I'm not sure if you see that on your end of things, where someone's portfolio or business may be valued at a fairly inexpensive price because of recent stock market decline, or even even with a private company situation where the company isn't doing well, and then the person separates, and then all of a sudden what they owe their spouse can be significantly less. So you sort of hear about those stories around 2008 with the stock market crash. I'm not sure if it happened like a year ago in March 2020. I mean, that was a pretty quick downdraft, but I imagine you have those kind of conversations with people from time to time, around sort of unusual times.
Well, usually the conversation is more a retrospective conversation. when people are sitting there, say today, and one spouse is trying to say, yeah, we separated in March, let's say May 1st, 2020, because the market, I may be off on my timing, was much lower.
Right.
The other spouse is saying, no, we separated in November of 2020.
Yeah.
Because the market had pretty well come back by then. So there can be these fluctuations. I mean, just picture if you were smart enough, probably, and I haven't checked the market prices, to have invested in Amazon, Pfizer, or Moderna, and you said you had your data separation in February of 2020, you'd probably be very happy with that post-separation.
Yeah, especially if you held on. Yeah, and so you know what we see in the past, and I've read a lot about one area that's can be sort of particularly troublesome is stock options. If you're an employee in a public company and you have vested stock options that are worth a lot of money at the date of separation, but the company subsequently, the share price starts to sort of decline rapidly. We've talked to clients where they say, wow, I owe my former spouse a whole lot of money based on the value of those options potentially. And I had no control over being able to exercise in some cases, and now they're worth significantly less. And so, I'm sure that's something that you sort of see from kind of time to time.
Well, what some of our viewers don't know is that you're also a chartered business valuator, even though you don't carry on in that practice. Yeah. So as you may know, the pensions I shouldn't say the pensions, stock options are valued using the Black-Scholes method. And it goes into the equalization calculation. You're entirely correct. Sometimes they get enormous values, and the timing of it is significant. I think of marijuana stock as an example.
Yeah.
You get a fight on the date of separation because you have an executive at a marijuana company who has either stocks or stock options or some combination of them. And on a certain date, they're worth millions. On another date, they're worth $100,000 or not even the paper they're written on, depending on the company.
Yeah. Yeah, I mean, I've heard lots of stories, with sort of high-tech executives. And I recall both you and I are unfortunately old enough to think back to this, but in the sort of tech run-up of 99 and 2000, I remember hearing a lot of stories where on paper, you had people that were CEOs of these .com companies that were $500 million, and 6 months later, they're worth 5 million, but they got separated in the middle. And it's a real problem because they never had that liquidity. It was just on paper.
Well, the good fortune is since that took place, there's a Court of Appeal decision called Sarah. And in that case, the court said that you can come to court and say that it would be unconscionable to equalize the net family property. And in that case, Mr. Sarah's equalization payment would have exceeded his net worth by the time the case went to trial, because he was in the textile business and they separated before China was heavy into that industry. And then by the time they went to trial, his business was worth a fraction of what it once was. And the court basically says, if it's something that's out of your control, that's grounds to do it. So there's a big difference, I think, when you're sitting there and you may say, well, I had a stock portfolio and it went from 10 million to 5 million, and I could push the button at any time to sell, and I chose not to push the button to sell, versus I'm the CEO or CFO or something of an executive at a publicly traded company that recently went public, and I'm prohibited by law from disposing of those shares. And by the time that we got to trial, those shares that had a $100 million value on the date of separation were worthless. I think that Sarah argument would carry a lot of weight to get an unequal division of net family property to sort it out, because it just doesn't seem right when the wife in that situation, or husband, as the case may be, ends up with everything because the equalization payment far exceeded that and the other spouse is bankrupt. And the courts will deal with that. I noticed that we're now out of time, John. So I wanted to thank you for being on the show. It was a pleasure having you, and I appreciate you sharing your experience. The next Ask Andrew show is on August 18th at 7:30 p.m. If you have any requests or ideas for future shows, please email them to info@feldsteinfamilylaw.com. And thank you for watching.
Thanks, Andrew.